The IRS has a rule that says if you earn too much money, you're not allowed to contribute to a Roth IRA. Full stop. No exceptions. High earners have a completely legal way around that rule anyway, and it's been sitting in the tax code for over a decade. It's not a gray area. The IRS has explicitly acknowledged this strategy exists in its own official guidance. And there's a second, much bigger version of it that most financial advisors don't even mention, that can move up to $55,000 a year into completely tax-free growth. I'm Kevin. This is Prosperity Levels. Today, the 2026 income limits. The two-step workaround. It's the single mistake that turns it into a tax bill, and the bigger version almost nobody uses. Quick note, not a financial advisor. This is educational. Talk to a professional before executing any of this. Getting a step wrong has real tax consequences. For 2026, the Roth IRA contribution limit is $7,500 a year, or $8,600 if you're 50 or older. Whether you're allowed to contribute that amount directly depends entirely on your income. For single filers, the phase-out range is $153,000 to $168,000. Below, full access, above, zero. For married couples filing jointly, that range is $242,000 to $252,000. Same structure. In between those numbers, your allowed contribution shrinks proportionally, rounded to the nearest $10. These income levels aren't extreme wealth. Single professional or two moderate incomes combined cross this line without feeling remotely rich. Once you're over the top of that range, the direct path is completely closed. No exceptions. Here's the workaround. Exploiting a gap in the rules the IRS has never closed. Here's the workaround. Exploiting a gap in the rules the IRS has never closed. There's also no income limit on converting money from a traditional IRA into a Roth IRA. Open since 2010. Put those two facts together. Contribute to a traditional IRA non-deductible, then convert into a Roth IRA shortly after. Step 1. Open a traditional IRA, contribute up to $7,500, non-deductible since you're over the income limit. Step 2. Convert that traditional IRA into a Roth IRA, usually within days, to avoid growth before conversion. Step 3. File IRS Form 8606 with your tax return, tracking your after-tax basis. If you convert quickly, the conversion creates little or no taxable income, since you're moving after-tax money. As of 2026, this strategy remains completely legal. Proposals to close it have never passed. Here's the single mistake that turns this clean strategy into an unexpected tax bill. The backdoor Roth only stays tax clean if your traditional IRA has a zero balance first. Otherwise, the pro rata rule applies. The pro rata rule treats every traditional IRA you own as one combined account, even at different brokerages. Real example, a $91,400 rollover IRA from a former employer, plus a new $8,600 backdoor contribution, total combined balance, $100,000. The IRS doesn't let you convert just the new contribution tax-free. The IRS requires converting a proportional slice of the entire balance to 91.4% pre-tax, 8.6% after-tax. Converting $8,600 means 91.4%, or $7,860, becomes taxable income tax paid on money already taxed once. Standard fix. Roll old pre-tax money into your current 401k first, clearing the IRA balance to zero. Everything so far covers the standard backdoor Roth, worth up to $7,500 or $8,600 a year. There's a much larger version. It's called the Mega Backdoor Roth. It's working through your 401k instead of an IRA for 2026. The total combined limit across all 401k contributions, deferrals, employer match, after tax is $72,000. Your regular employee deferral limit, separate from that total, is $24,500 for 2026. $32,500 if 50. If your plan allows after-tax contributions, you can contribute beyond your deferral up to the $72,000 ceiling. Best case, with no employer match reducing the room, up to $47,500 in additional after-tax contribution space. If your plan allows in-service distribution or automatic conversion, that after-tax money moves into Roth accounts regularly. Combine both, standard Backdoor Roth IRA plus Mega Backdoor 401k up to $55,000 a year into Roth accounts. Not every employer's plan allows this. You need to check your plan document or ask HR directly. Let's run the numbers on why $55,000 a year in Roth space actually matters over time. $55,000 a year invested at 8% entirely in Roth accounts. For 20 years, grows to approximately $2,516,910, completely tax-free. Compared to the same $55,000 a year in traditional pre-tax accounts, taxed at withdrawal at an assumed 30% rate, approximately $1,761,837. That's a $755,073 difference. Same contribution, same return, same 20 years. The only variable is account type. Now the Head Start version, just the standard $7,500 Backdoor Roth IRA, starting at $35 for 30 years to 65, approximately $849,623. Starting the same strategy at $45 instead, 20 years to 65, approximately $343,215, same contribution. Same strategy, the 10-year Head Start alone is worth roughly $506,408 by retirement. One major rule shift specifically affects high earners using these strategies the first year it's in effect. If your wages from 2025 exceeded $150,000, catch-up contributions must now be made on a Roth basis, not pre-tax. Before this year, high earners over 50 could choose. That choice is gone now for anyone over the threshold. This plays directly into everything in this video. The tax code is nudging high earners toward Roth accounts on multiple fronts at once. This isn't a claim that everyone should max out a Mega Backdoor Roth, or that these strategies are risk-free. You need earned income to contribute to any IRA at all. Someone living on investment income or Social Security can't use this strategy. Not every 401k plan allows after-tax contributions or in-service distributions, especially smaller employers. The pro-rata rule makes this complicated for anyone with a meaningful pre-tax IRA balance already. The 20 and 30-year projections assume consistent 8% returns with zero withdrawals, a long, optimistic time frame. Here's what's actually actionable this week, depending on where you land. 1. Check your Magi against the 2026 thresholds. If above, the standard Backdoor Roth is worth setting up. 2. Check your December 31st balance across every traditional, SEP, and simple IRA before starting to avoid the pro-rata landmine. 3. Ask HR or your plan administrator whether your 401k allows after-tax contributions and in-service distributions. 4. If 50 plus and earned over $150,000 last year, confirm your catch-up contributions are correctly routed as Roth. 5. File Form 8606 every single year you do this, without exception. Here's what this video actually reveals about the tax code. The rules that seem the most locked down often have a completely legal path around them. This isn't a strategy reserved for the ultra-wealthy, sitting in plain sight, available to anyone with the right income and a little paperwork. The real gap isn't legal access, it's information. Most people who qualify never hear about it from anyone with a reason to bring it up. If this changed how you think about your own income level and retirement contributions, hit the like button. $242,000, $252,000 MFJ, Backdoor Roth bypasses it. Mega Backdoor moves up to $55,000 a year combined. Over 20 years, using Roth instead of traditional is worth roughly $755,073 more. A 10-year Head Start alone is worth roughly $506,408. Subscribe for more. Next video. The hidden number that costs retirees thousands. This is Kevin. This is Prosperity Levels. I'll see you in the next one.